Good morning and welcome to the Monday Market Update. I'm Nash Paradise, Director of Sales here at UMortgage, and you may notice I'm by myself. Well, unfortunately, with the way that these rates have been going, we've got some budget cuts here and can no longer afford Andrew Katie's salary. It's sad, but I guess he'll be back next week, and that's not true. But it is rough out there right now. It has been a not so fun few weeks here as we try to balance out what's going on in the market, what matters, what can we anticipate, how do we plan and prepare for these things, and where do we go from here? What do we make of all this stuff? So let's start by jumping into last week. Yeah, that's gross. You know, it's a mid plus volatility. It was fairly smooth, but it was just a kick in the gut every single day last week, and we got a little bit of a relief going from Thursday to Friday. But as you can see here in the bottom right, like we started 671, which was gross anyway. You know, a lot higher than some of the levels that we've been able to hold at. But finishing the week, you know, we saw as high as 685 on the overnight daily average, and that overnight daily average doesn't necessarily mean that's what you're gonna get. That's a rate you're going to pay for. So as we get into the upper sixes, we start flirting with 7% interest rates again. It is the wrong time for that to happen. The market had already slowed down a little bit. We're seeing that midsummer lull. So the timing could not be worse here. But I'm going to find some good news today and something that we can get excited about somewhere in all of this data and this information, so it's not just a big old cry fest over here. So let's see what happened last week. Does anything matter for the data? And the big answer is no. Right now, we are not data dependent at the moment. We are war dependent. And we spent all last week trading bombs, trading missiles, trading, tactical operations with Tehran. And, we've got outside groups getting into this. Israel is still doing their stuff in Lebanon. We've got conflict escalating. And as conflict escalates, oil increases. And as oil increases, the cost of everything goes up. Energy is everything. So even looking through what we have here, ADP employment was fine. Initial jobless claims, better than expected. Cool. Jobs are fine. S&P, PMI, fine. Everything's fine. No one cares about last week's economic calendar. It wasn't very fat anyway. But we certainly aren't going to care about the economic news when we have bombs and missiles going off. So that's what last week was. I don't even want to focus on that any further because it's completely irrelevant. Let's get into this week. And this is another week. We've had a couple of these Fed meeting weeks where we're just going a little out of order here. The timing doesn't work out great. We've got the Fed meeting on the 29th, which is Wednesday. We're going to get a Fed interest rate decision. We're going to get a press conference. I've been saying for a while that the markets aren't loving Warsh's pressers, and he's only had one, but they didn't like it. So, from here, I'm always a little worried about Fed pressure day, and I would continue to be concerned about Fed pressure day, especially considering what happened last week. Everyone's a little on edge thinking, oh, man, we know a Fed rate hike is coming, but could it be coming sooner rather than later? And we've gone back and forth between do we need one hike or are we going to need two? Markets can't seem to predict where we're going with that. Now we do have good data coming in this week, but it's going to be on Thursday. You can see Thursday is very full. That's our first red bars here. We got PCE, core PCE, all the PCEs, and they are targeted to go down, which based on last month's PCE numbers makes sense. Having this drop in overall inflation numbers in the midst of rising costs, rising oil, rising tension and escalation is kind of set up for failure here. We've been getting lucky, and things have not been going too bad on inflation, but this is room to miss. So it really could be a 1-2 punch this week with Warsh's presser. If the Fed holds rates steady, which we'll talk about in a second, and depending on what he says, and then if we happen to miss and we show higher inflation after the Fed presser, yeah, it could be bad. So I would definitely be getting what you got locked if you have things in front of you. So that's this week. Moving on. Let's talk about the Fed funds rate. This is uglier than it used to be. Right now we're at that 375 mark, and that first bucket, 350 to 375. And I've been saying for a while we should feel pretty secure about a non-move in July. It's a little too soon to increase interest rates. We haven't seen the inflation numbers, show that need. We haven't seen gangbusters jobs reports that say we need to increase rates. And it's really, tied most to anything at all right now is going to be the inflation. Inflation's been okay. It actually has come in a little bit lower than expectations. And yet we've moved from 90% certainty of no rate hike all the way down to 66%. There is now some real risk of a rate hike on Wednesday, and this could change as we get a little deeper into the week. Now, I don't think it will, but I would anticipate us sitting here in this existing rate environment. But what makes it ugly is, for a while we were thinking one rate hike, sit steady for a significant amount of time, like the next 6 or 7 cycles, and then possibly come back down, possibly even out. And now we are showing 2 rate hikes. That 425 mark could be in play as soon as December of this year. And this has happened before. We've seen this before in the last couple months where, all the aggregate, analysts are predicting a second rate cut, and then they came away from it. So does anyone really know? No. These things can move, and these things will continue to move. But as of right now, the likelihood of a second cut or a second increase is extremely high. And if we get into Wednesday with too much ambiguity around what the markets think the Fed is going to do, that could cause the markets to be even more wild in the way that they react to whatever Warsh happens to say. So I don't like it. Not a lot of fun. I do think they'll hold, but we're looking pretty certain at a September increase right now. Look at that, 97%, with 0% saying that we stay the same. Now, I do think that'll move if we can get out of this Iran situation. But for right now, this is the world we're living in. This is what we're working with. Rates are going up. Speaking of rates are going up, how about the ugliest chart of the week? There we go. We have been living in this world where, looking back over the last 12 months, we saw where we got away from the grossness. We dropped back down. We lived in a world around 6.25. Then we had some varying degrees of increases, pop back down, increase, pop back down. We're right up there. We are in a 1-year high, and we're not even tracking the UMBS 5.0 security anymore. We have moved on to the 5.5%, which is really significant because if you're bundling on a security that has moved up 0.5%, you really are pushing into a new world of the increases are that significant. And looking at the, rolling averages on the, 25-day, 50-day, 100-day, we're just not real close at all. This increase in rates has happened very suddenly, and sudden increases in rates are generally going to be pretty bad for the market and how they react. So the takeaway here, nothing you can do about where pricing is other than how you frame it. It's going to be harder to find wins. There are going to be plenty of people out there who are getting wins right now. Some of those are coming in the form of, FHA, VA, USDA loans for, first-time home buyers, young buyers. I will say my average loan size in the last couple of weeks has dropped significantly. I'm seeing a lot more $250,000 to $350,000 offers going out because these are my young buyers, my broke first-time home buyers, people who need some seller concessions and credits. They're the ones who are out in the 7% interest rates. They're the ones who are coming out again now. So it's not an ideal market. It's not even a balanced market. You need things to be moving at every end of the spectrum in order to be as successful as possible. But for right now, we need to get in front of people who are willing to take action. So find those young buyers, first-time buyers, people who need to make a change in their situation. These upper sixes aren't really going to scare them off. But we are far enough away from that, 6.3, 6.4 range where we are actually manipulating and messing with affordability again. So kind of bad news from this side, and there's no reason to believe that's going to go down unless things recover overseas. So to kind of close out my thoughts and all that, what's been going on, why did we get a little bit of an improvement Friday? Well, we have a unofficial agreement to stop trading bombs and missiles, to stop attacking each other in Iran. And oil likes that. Of course, it keeps happening over the weekend, which is ridiculous because markets can't really react in real time. But we keep having these, Friday after hours or Saturday, mid-morning decisions that markets have to deal with when they're opening. And as of this moment, we are not doing any airstrikes. So, is that the prelude to going back to peace talks? I don't know. A lot of people are anticipating it is, and oil is reacting like it is. And if it is, cool. But unfortunately, we've broken trust of every global market. There is no trust, even if a new peace deal is inked. Until we get some distance away from that, and until everyone's on board, until everyone feels like they have what they want, markets are not going to respond as quickly as we would like them to. And we've just been in this world too long. No one believes anything that they hear anymore, because I'm pretty sure this conflict has been ended like 32 times at this point, and we keep getting into re-escalation. So when trying to explain to the average consumer, to the real estate agent, to someone like what's going on, why are interest rates where they are, you got to explain like the markets have trust issues right now. No one believes much of anything, and the economic data can hurt, but it's not particularly helping. When we had great econ data, which would have normally dropped 10-year treasury yields significantly, we got a tiny drop. It was very muted. And that's going to be what we'll continue to see for a while. So, everything can change in a week. Everything could change after the presser and after PCE if we start to get some confidence and can get some traction and momentum in one area or another. Then great. Then we can start seeing some good movement. But until that happens, until we cross that line, there's no reason to believe anything's going to be any different anytime soon. So we need to find the wins, make the phone calls, stay in touch with the people, recommit to old pre-approvals, let them know what's going on. Get some data about price drops in your market. Get some data about appraisals coming in high. We've got to be able to find the wins in there. And, maybe paying an extra 0.25% on your interest rate is rough. It impacts your payment by, $40, $50, $100 a month. But if you can save $20,000, $25,000 in the sales price, you can find a way to turn that into a win. You just need to look a little harder, have a little more data, and be the expert that shares the good news that you can find with the people who need to hear it. So until next week, appreciate you tuning in, and I hope to have some better news when we're back.